Today, we're going to explain an opaque but fairly easy to understand concept of naked short selling. This explanation will be straightforward and without jargon. I like to call it Wall Street for Dummies. Let's start with two simple concepts on Wall Street: long versus short. When we understand these terms, we can move on to more philosophical issues. Here it is. If you own a stock or commodity, you are long that asset. If you don't own or you sell an asset, you are short. This gets slightly more complicated when institutions and traders create complex derivatives to extend the concept of long and short into the future. These derivatives include forward contracts, options, and even more exotic instruments. But no need to go into these at this time. Suffice it to say, if you buy or own an asset, you are long. If you don't own it, or have borrowed it, or have sold it contractually, you are short. In the next few minutes, we will examine whether there is value in selling something you don't own. This is called a naked short. If there is no value to the general public or even a danger, we as a society must then decide, if we don't like it, can we rectify the situation? This is where the blockchain comes in, so let's jump in. What if I told you that one of the most controversial practices in finance could simply disappear? Not banned, not regulated, not debated, but rendered impossible. In a previous episode, we explored short selling, a force that profits from decline. In short selling, a trader borrows a stock or commodity and sells it to another individual with the intention of buying it back at a future date. The trade works if the price of the stock or commodity drops and the trader liquidates his position by buying the asset back at a lower price. Useful when honest, dangerous when abused. And at the center of that danger was something called naked short selling, selling what you do not own, selling what you have not even borrowed, creating pressure from nothing, a kind of financial illusion. This is what is commonly called the paper market rather than the physical market. This is particularly worrisome when the asset traded is a precious metal like gold or silver. In today's derivative markets for precious metals, traders can sell silver without first borrowing the metal. This is called naked short selling. The market has become so advanced that actual silver is never swapped. The exchange merely shows ciphers of who owns what, who sold what. In the worst-case scenario, a buyer could ask for delivery of physical silver. Then it is up to the seller to deliver. There is currently not enough physical silver in the world to cover all of the silver shorts. The exchanges know this, and in many cases they insert legalese that specified delivery need not be in physical commodity, but can be settled for cash. Now, traders are limited in number and generally known to each other. They net their trades, and most have no interest in the physical commodity. But here's the real question: how is naked short selling even possible? How can something be sold that does not exist? The answer is uncomfortable, because in traditional markets, ownership is not as clear as we think. There are brokers, custodians, clearinghouses, settlement delays, and somewhere inside that complexity, reality or ownership becomes negotiable. In a previous video, we discussed the Depository Trust and Clearing Corporation, an entity that holds all stocks traded on Wall Street in a nominee name and creates a confusing chain of ownership through stock issuers, custodians, nominees, and brokers. In that video, we focused on an alternative ownership chain using blockchain. In this video, we will focus on one specific tactic in stock and commodity trading: naked short selling, and we will attempt to tie it to new blockchain technology. The trade is made today but settles tomorrow or the next day. In that gap between promise and delivery, something strange can happen. A share can be sold before it is ever located, and for a brief moment, the system believes it exists. Multiply this across millions of trades, and you arrive at a profound possibility. Supply can be manufactured, not by printing shares officially, But by stretching the system beyond its limits, this is the shadow where naked short selling lives. Now consider the market for gold and silver. Skeptics believe that this market can be manipulated using paper short contracts. While not proven, there have been recent court cases against major bullion bank traders that point to manipulation. When the amount of paper silver contracts traded daily actually exceeds the total amount of physical existing in the world, the system is probably rife for manipulation. To counter the risk of buyers actually requesting delivery of their metal purchased, the exchanges have established rules that allow for settlement in cash. So far, the system is working, but it is a fragile system nonetheless. Now imagine a different system, no intermediaries, no delayed settlement, no ambiguity, a system where ownership is not recorded in layers, but exists as a single verifiable truth. This is the promise of blockchain. In a blockchain market, every share becomes a token. One share, one token, no more, no less. It cannot be duplicated, it cannot be counterfeited. It either exists or it does not. And when a trade happens, it settles instantly. Not tomorrow, not later, now. Buyer pays, seller delivers. One atomic event, no gap, no delay, no opportunity for illusion. And here is the critical moment. If you try to sell a share, the system asks a simple question: do you have it? If the answer is no, the trade does not happen. That means there is no naked short sale, no exceptions, no loopholes, no "we'll find it later," just no. But short selling itself does not disappear, it evolves. Traditional borrowing of a security to sell it short can continue as a financial strategy. Blockchain merely creates a mechanism to disallow short selling an asset you don't own or borrow. That is naked short selling. To short a stock, you must first borrow the token. That borrowing is recorded, verified, locked, collateral is posted, rules are enforced automatically, not by regulators, but by code. And for the first time in financial history, we could see everything. Total shares, total shorts, total lending, all in real time, no delays, no hidden positions, no shadows, just truth. This is not just a technical upgrade, it is a philosophical one. Because naked short selling was never just a tactic, it was a symptom of a system where records could drift from reality, and trust had to fill the gap. Blockchain does something radical. It removes the need for trust, not by trusting better institutions, but by eliminating the conditions that require trust in the first place. Ownership becomes absolute, settlement becomes final, truth becomes verifiable. But there is a catch, and it is an important one. Even if the underlying asset is pure, a synthetic layer can still be built on top. Derivatives, ETFs or exchange-traded funds, futures, paper claims on real assets. And if that layer grows large enough, we may once again find ourselves asking, is price reflecting reality or abstraction? Bitcoin began as a system of absolute ownership, no duplication, no ambiguity, but today, even Bitcoin is entering the world of synthetic finance, and history suggests this is where things become complicated. So, will blockchain end naked short selling? The answer is complicated. Blockchain can easily show a chain of ownership using tokens. However, the trading community, the regulators, the politicians, and yes, the public at large must decide whether naked short selling is a benefit or detriment to a society. Only then will the verdict be known. But whether markets remain honest will depend on what we build on top. Because technology can enforce truth, but only philosophy can preserve it. Please watch for further videos in which we explain how blockchain provides solutions to everyday problems. Thank you for your attention to this matter.